Introduction. At the very core of modern accounting lies the double entry system, a time-tested method that ensures every financial transaction is recorded with complete accuracy and balance. The double entry system not only maintains equilibrium in financial records, but also acts as a foundation for preparing reliable financial statements. This module explores the double entry principle, the structure and function of the ledger, and the posting process, giving you the tools to track financial transactions effectively. Understanding the double entry system. What is double entry? The double entry accounting system requires that for every financial transaction, two accounts are affected, one is debited, and the other is credited, maintaining the fundamental accounting equation. Assets equals liabilities plus equity. Key principle. Every debit has a corresponding and equal credit. This ensures that the books remain balanced at all times. The golden rules of accounting. Depending on the type of account, different rules apply to determine whether to debit or credit. 1. Personal account debit the receiver, credit the giver. Example, paying a supplier, debit supplier, credit cash. 2nd, real account debit, what comes in, credit what goes out. Example, buying a vehicle, debit vehicle, credit bank. 3rd, nominal account, debit, all expenses and losses, credit all incomes and gains. Example, earning interest, debit cash, credit interest income. 7.4. The account types and their normal balances. Account type normal balance assets. Debit liabilities, credit equity, capital. Credit revenue, credit expenses. Debit. Understanding the normal balance helps determine how a transaction affects each account. Journal entries, the first step. A journal is the first place where financial transactions are recorded chronologically using the double entry format. Example 1. Paying rent, 50,000 naira. In cash date, January 2nd, Dr. Rent expense, 50,000 naira. Cash 50,000 naira. Narration. Being payment of monthly rent. Example 2. Credit sale of goods worth 80,000 naira. Date, January 5th. Doctor accounts receivable 80,000 naira. Sales revenue 80,000 naira. Narration. Being goods sold on credit. Ledger. The book of final entry. The ledger is where transactions from the journal are posted into individual accounts, making it easier to summarize financial activity by account type. Each ledger account has a T account format. Cash account. The date. Particulars. Debit. Credit. The January 1st. Capital introduced. 100,000. January 2nd. Rent paid. 50,000. Ledger posting procedure. Steps to post to the ledger. Identify the accounts involved in the journal entry. Determine which account is debited and credited. Open the ledger accounts for each. Enter the debit side of one account and credit side of the other. Include date, description, and amount. Example, posting, rent payment, journal entry, Dr. Rent expense, 50,000 naira. Cash 50,000 naira. Ledger, rent expense account, date particulars, debit credit. January 2nd, cash 50,000, naira cash. Account date, particulars, debit credit. January 2nd, rent expense, 50,000 naira. Balancing ledger accounts. After posting all transactions, each account is balanced by adding the totals on each side, finding the difference, if any, entering the balance CD, carried down, bringing down the balance to the next period as balance BD. Example, cash account, after several entries. Total debits, 100,000 naira. Total credits, 70,000 naira. Balance CD equals 30,000 naira. This becomes the opening balance, BD, for the next period. Trial balance. The trial balance is a list of all general ledger accounts and their balances at a specific point in time. It's used to check the accuracy of postings and to ensure that the sum of all debits equals the sum of all credits. Example, account debit, naira. Credit, naira. Cash, 100,000. Office supplies. 50,000. Accounts. Payable. 50,000 capital. 100,000 total, 150,000, 150,000. Importance of the double entry system. Accuracy reduces errors, as every entry is checked by its opposite. Traceability. Easy to trace how and where money was spent or earned. Fraud prevention. Manipulating one side must be countered on another, deterring fraud. Preparation of trial balance. Since every debit has a credit, trial balances can be easily prepared. Financial statement. Readiness ensures accounts are structured to flow into the financial statements. Common errors in ledger posting. In this course, we will be using error and impact in our table. 1. Omitting a posting. Unbalanced books. 2. Posting on the wrong side, inflated or deflated balances. 3. Wrong account used, misclassification of data. 4. Double posting of one transaction 5. Overstated results. Tip: cross-referencing with journal entries helps detect and avoid these mistakes. Computerized ledger systems. Modern accounting software like QuickBooks, Tally, and Sage automate journal entries and ledger postings. Still, understanding the manual system is critical to spot automation errors, build foundational knowledge, pass accounting certification exams. Summary: Module 7 covered the double entry accounting system and the posting process to the ledger, the backbone of financial data organization. This systematic approach ensures every transaction is captured in a balanced and traceable manner, enabling accurate financial reporting and sound decision-making.